Good afternoon. Welcome to the TheoTrade Afternoon video. I'm Blake Young. Today is December 4th, 2025, and we're going to talk about the balance that was in the market today and what does that mean for looking forward. Looking at the sectors in the movement, you can see I've got my list of sector ETFs over here. We also have crude and bonds and coincidentally Google thrown in the mix, but we have roughly the equal amount of sectors positive as we do negative, and roughly the same number are above as below are also percentile, with a slight skew to the downside because the top sector was up 0.57 and the bottom sector was down 0.76. So very balanced. The way I'm reading this is extremely balanced day in the market. Same number of sectors up, same number of sectors down. Equities closed nearly flat as far as the futures are concerned, including gold, and the market just couldn't get out of its own way. Add to that, we could look at the advancing decline lines from other websites, say 53.9% up, 42% down, so slight bullish as far as advanced decline. We had 226 stocks hit new record highs, while 67 hit new record lows. We're starting to see more lows hit, and you can see that from the simple moving average. We have 49% above and 50.8% below the 50-day moving average. Even the 200-day moving average, which is normally used for puts, and this is showing that we are seeing that the pressure is balancing out, and we're seeing as many stocks that are in sell or buy put type of structures as we do in bullish or above the 200-day moving average. And just being above the 200-day moving average does not necessarily mean bullish. It just means not hedging or buying puts to take advantage of a bearish trade. And if we zoom in on the S&P futures, you can see our fair price as far as the month of December monkey bars is dead on and almost perfectly flat candle. 4 points off the center, 0.07%, and the futures are still open right now. But in essence, almost perfectly flat trading day in the S&P futures. So what does that mean? What does that tell us? We can see represented in the 1-minute chart today's actions from the open, 9:30 Eastern, 7:30 my time. You can see that we started off with a bunch of selling off of negative economic data and uncertainty. We pushed implied volatility up to the high, and we saw a lot of sell-off through here. We can see at noon my time, 2 p.m. Eastern, we saw a spike in implied volatility from 14 up to 14.5. It doesn't seem like a lot, but that was also contributing to a 30-point drop in equities. Now, as we finished the day, we went flat and low, which means we popped up and then traded flat for the rest of the day. I'm seeing this as a lot of uncertainty, a lot of balance, yes, but uncertainty as we can sell off this quick and this quick in a matter of 20-30 minutes while it takes us all day to claw it back. So as we have this uncertainty going into the overnight ahead of major economic news, I think we are prepared for the next leg down. Even though we found fair price, we could expect a quick move of about 30 to 40 points down, 30 to 40 points down. So we could be looking at early morning tomorrow. If we have good or bad economic data, we might see an initial drop in equities in response to the economic reports. Tomorrow we have important information, specifically core PCE price index. The PCE, the inflation index, this PCE is what the Fed uses to determine whether it needs to raise rates, cut rates, or hold them steady. We have consumer sentiment and inflation expectations from the University of Michigan. So this situation is telling us that we are going to see inflation data that is going to be very impactful. You might notice that something is missing. Normally, the first Friday of each month, we'd expect to see non-farm payroll. The problem is non-farm payroll will not be released this week. It'll be released next week on Tuesday, or a week from Tuesday, excuse me, on the 16th because of the government shutdown. So we still don't know how bad the labor market is, and we keep pushing it out, pushing it out, pushing it out. We're now multiple months behind schedule, and that non-farm payroll that does get reported on the 16th could be significant catalyst to push the markets up or down, but I'm guessing that it's probably not great news. So we'll see how that plays out. So inflation data is the one for tomorrow, and we're going to watch to see if consumer sentiment hits or misses. Preliminary University of Michigan consumer sentiment normally is going to be less important, even though it's written as important, but we're going to grasp a hold of any bit of information we can to price things. And I do think tomorrow is going to be a significant morning for us as far as report-wise and movement-wise. So where are we going to look to trade? We're going to talk about two different areas. We're going to talk about financials, and which is tied directly to consumer discretionary spending, or consumers, and we're going to talk about energy. So starting with energy, if you've been listening to me for the last couple of weeks, whether live or here, you know that I've been focused on energy stocks, and I like energy stocks. I think this is a place to look for opportunities. You'll notice that energy implied volatility is very, very low. That means you can get away with buying the stocks, the underlying stocks inside of XLE. You can also buy individual options like call options or call option spreads, and I think they're all pretty good setups at this point. If you look at CCJ as one of these, an opportunity. Now this is not the same kind of energy. We're not generally looking at this as an oil stock, but CCJ is an energy producer, specifically providing energy through uranium, and it will tie very closely to AI and AI needs. CCJ had an amazing bounce through here, pulled back, widened out, and is right on the cusp of a buy signal. So I like the setup of this chart. We could see CCJ go back to 110. That would give us about an 18% return on the underlying price, with a stop that you could get away with probably right down here at 86. For a longer term trade, I would go to the January for at least 2 months, maybe even go out to March, but dealing with the January, buy a delta near 70. The closest one is this 65. Let's go with the 77 delta, go to 85. You'd be paying $2.68 of time decay to buy the 85. And then if you sold 3 weeks worth at a delta between 30 and 40, you would in essence be paid all your time decay. It turned it into a delta or a theta neutral trade, and then you collect an additional $2 to $3 next month into a vertical spread. So I like CCJ for either trade strategy, and both could work out really, really well with a pretty safe position. Now if we look at financials, it looks pretty positive, bullish, but I'm not looking at financials as an overall view of the financial sector and banking. I want to look very specifically at credit cards, but not credit card defaults, which is normally what I'd be looking for right now, but credit card usage. We're in the holiday season. This is when we normally price in a lot of expectation, a lot of spending, a lot of transactions. Visa and MasterCard are driven off of transactions, not off of carrying balances, not off of defaults. And what we're seeing today is a bearish situation and a bearish breakout potential on Visa to the downside. Visa is my canary in the coal mine. And so as we're looking at Visa, we break down through here, this is not promising for the consumer. If we're doing less transactions and pricing in less and less transactions, we have lower highs and lower lows, and Visa breaks out through 327. I think we could drop down to 308 before the end of the year. Currently implied volatility is relatively low compared to what it was in the last 6 months, and we might be able to just buy a put or put spread in Visa. And the put spread out to January looks pretty attractive because we can buy a delta near 70 and we'll pay $267.50. Now it's an expensive contract because it's $340 stock, but it's 70 delta, maybe $16 if we can get somewhere between the bid and the ask. It's aftermarket, so this has gone a little bit wider. And we're going to pay about $2.60. We could stay in the same time frame, buy the 340, sell the 320, and get paid all of our time decay and more, so that we are in a theta positive trade that could turn into a $20, $25 trade here. So we get an extra $250 from the current price, and it gives us a safety net. If it just stays flat, we'll make a return. If you wanted to sell a different expiration, you'd buy the 340, still paying the $267 in time decay, sell the December, and we could sell the delta of 30 at 320 and collect $2.80 to $3 here, pay for the time decay again, and do it one more time in January, and we should get an extra $3 and give us the opportunity to even roll down our strike. So it could become worth a lot more. Instead of just a $20 trade, it could become worth $25 or $30 vertical by the time we roll it into January. So I like both of these as well. The idea is trading bearish on Visa on the breakout, assuming that consumers are stretched and are going to be using their credit cards less as far as transactions go. They're going to be more selective about what they're buying. It's not a matter of balance, it's a matter of purchases. And we're seeing lower highs, lower lows, and a continuation lower in Visa. Consumer sentiment tomorrow will likely only make that more dramatic, and we could see a bigger sell-off in Visa. So those are the two kind of extremes I'm looking for. Continued growth and expansion of AI driving demand for electricity and pushing CCJ for these little pocket nuclear energy facilities, or going against the consumer, that the consumer is going to be spending less money and therefore Visa is going to slow down in the number of transactions and therefore Visa is going to drop down to 310 or lower. That's going to do it for me today. Watch for those reports tomorrow morning before the market opens. It'll give you some insight as far as how the market is feeling. And based off of what we saw today and the uncertainty in the balance is teetering at a key level. And I do think that we could see very quick drops in U.S. equities across the board, but specifically in consumer discretionary and consumers overall. Thanks for watching. We'll talk to you again tomorrow.